Interestingly, many of us have SIPs, the systematic investment plans, but are we aware of this rule of 7531, which should be all the time in our mind when we have a SIP with us? So, we are going to understand the 7531 rule today, which will help us more cautiously invest in SIPs and be patient and have these rules in our mind so that we don't make mistakes. So go through this entire video in detail so that you get an insight into the 7531 rule of SIPs that can build your portfolio and make you a better investor. So let's take this understanding of the rules. So now first let us understand what are SIPs. Now SIPs are basically, as we know, systematic investment plans. Now this is basically where you put in small amounts of money every month, and specifically we are talking about mutual funds. So every month you're going to put some amount towards a specific investment which is already decided, pre-decided by you in terms of mutual fund. So if I decide on a specific, let's say conservative mutual fund, I'm going to put every month 5,000 rupees in that fund. This will build my fund towards the end of the year up to 60,000 plus whatever the asset value has increased, right? So this is where you're talking about SIPs in small amounts every month. Now, another important thing is this method of investment is specifically to mutual funds, and it is popular amongst those which are having a fixed income every month. So it's like salaried employees normally prefer this kind of SIP. Also business organizations which have a fixed amount of profit, or let's say they don't have a fixed profit every month, but at the same time they are sure that they will be able to afford this amount of investment every month, they will resort to SIPs. People who don't have a chunk like lump sum got in a specific month or a time period of a year, like some industries may have seasonal amounts being received, so they may prefer a lump sum investment over SIP. But this is generally for those people who have a fixed income earning every month. Then comes this particular rule 7531. Now, what is this specifically? It is connected to how to plan your SIP. Okay, how to basically have your SIPs designed and how the portfolio should be planned. Then this rule gives you the maximum benefit of return in terms of SIP and helps you build a proper portfolio so that you have in the long term you don't have any issues. And incremental growth, that means if you remember power of compounding that we had discussed earlier in mutual fund video, where we spoke about incremental growth. So every month you're putting in money and interest on interest accumulates. Similarly, benefit of investment also accumulates. So interest, dividends, whatever we are talking about, that on that again you're going to get a benefit of interest or dividend or whatever. Now let's consider first of all the 7531 rule. In that, what is the 7 basically says that SIP should be in kept in hand for nearly 7 years time duration to reap a benefit equivalent to the lump sum and get reasonable returns. So this rule is important from the point of view of getting reasonable returns, and this can happen only if you maintain this to the extent of 7 years time duration. Now, where you are going to get the benefit of compounding. Now, if you are investing every month, naturally the benefit of lump sum is not got, because once you put in the money, this remains in hand for the next upcoming time period or 1 year. But in this case, it is not so. What is happening? You are putting every month in bits and parts. So this month 5,000 will be accumulated for the next 11 months, 12 months. Next month you put in, that again requires a time period of 12 months. Let's say at the year end you have a accumulation of only 11 months of returns. Then if you put in the third month, what happens? Third month will have benefit in a similar way of only 10 months and so on, right? So basically the compounding effect takes place gradually in comparison to lump sum, and that's the reason here you have a time duration of 2 years extra compared to lump sum. The next part here we find that minimizes the chances of negative return. So if you hold this particular SIP for a period of 7 years, there is a minimization of a chance of getting negative returns. Now, if you see mutual funds also, if you keep looking at the portfolio every day, your heartbeats can increase, right? Because you find very negative return. Now suddenly there are losses. Now suddenly it's gone only 2% increase and so on. So if you know properly and correctly how to deal with a mutual fund, you know it takes time, right, to build that particular amount of return of maybe 20%, 18%, whatever is the target. So it will take some time, and that duration generally we stick to is 5 years. So a 5 years portfolio in mutual funds is very beneficial. Of course, very peak ups and downs, you have to keep a watch and then accordingly take the decision. But at the same time, on an average, we say 5 years. Similarly, for SIP, we say 7 years duration. So rule that comes 7531, the 7 relates to holding that particular mutual fund for a time duration of nearly 7 years to reap the benefit of reasonable returns. Next rule we have is basically the 5. So what is that 5 here? We are talking about these 5 split of these 5 investment opportunities. So invest where? In the mutual funds which have large cap stocks. Invest in the mutual funds which give good value giving stocks, then rapidly growing company stocks, global stocks, and some portion of it will go to mid cap and small cap stocks. So it's a culmination, it's a combination of 5 of these mutual fund portfolios. So it's not just one thing that you put all your money in. You have to distribute your SIP, whatever you decide, let's say 20,000 worth of SIP, 50,000 worth of SIP. You have to distribute it in these 5 portions to give you the maximum returns. So large cap stock specifically is something which is a little bit more conservative. Good value giving stocks and rapidly growing stocks, mid cap, small cap stocks, global stocks, all these will come in more aggressive type of funding, and based on this you get the highest amount of returns from the combination. Now coming to next part, that is 3. 3 is for the 3 phases that maybe investors face. The first phase is not so happy phase because they're getting just 8 to 10% returns in a certain time duration. So impatience grows. The investor starts feeling, it's already 2.5 years, 3 years now, and should I quit? So this is a not so happy phase of the investor. Then sometimes they may also feel that still the portfolio is showing only 0 to 7% returns. Are FD mein dalte to acha hota, right? We get at least 6.5 return fixed there, and we don't have the headache. But this is the phase of irritation and anger that the person may face in investment in mutual fund. There can also be a panic phase where the stage says that okay, negative returns are there, minus mein ja raha hai. I just invested and I'm seeing now negative returns. So this is because of the ups and downs of the market. Be patient. So remember that 7, the first part of the rule, 7531, when you remember, you have to understand that mutual funds and investments in SIPs will take some time and you have to be patient. So even if you're going through these 3 phases, look at the first rule and see if it is 7 years and you're still getting bad returns, is a negative return still showing after a phase of 5 to 6 years? So depending on that, you will have to understand your mutual fund portfolio. So 3 is these 3 phases which need to be patiently taken up. And finally, we have 1 that we have to do every year, right? What we have to do every year, increase your SIP amount. So if you have decided that this year I'm going to invest every month 50,000 rupees, next year on, that is after 1 year, what you have to do, increase that SIP amount. Maybe you've got a promotion and this year you have 20,000 extra in hand. So what you do, instead of investing only 50,000, this time you decide I will invest now 60,000 or even 70,000, depending on your amount of investment that you can really shell out in that particular time frame. So every year increasing the SIP amount. What is the benefit now of this rule? This rule helps you to reach your goal faster, of course, right? Because 7 years you don't have to wait. Then maybe 4 years only your goal can be completed, whatever is the pre-decided rate of return and the pre-decided investment that you want to build. Then you will also expand your current financial goal. Probably what happens, you wait for 7 years, but if you have decided that after 7 years I want to get 3 crore, you might get 5 crore if you build on your SIP every single year. So every year you are supposed to do this. Every year you are going to increase your SIP amount. So this is what is the 7531 rule of SIP. Hope you find this useful and you build your SIP portfolio and a good portfolio in a short duration of time with this 7531 rule. Just in case you have any questions or any comments, you please put it in the comment box and share this video to people who might find it useful. Also, if you have not joined the journey of Commerce Gyan yet, do subscribe to our channel, and also hope to see you in the next video of Commerce Gyan. Thank you.